Well, the Los Angeles Economic Development Corp's forecast released yesterday shows Hollywood is going to be looking to hire. The good news, the report says Hollywood will need to fill 1,000 jobs this year and 2,000 next year, despite movies setting a record in sales last month, over $1 billion. The allure to shoot films outside of California may hurt the prospects of those potential jobs. For more this morning, I'm joined by David Brain, CEO of Entertainment Properties, in a Fox exclusive. Good morning, David. Good to see you.
Good morning, Alexis. Thank you. Good to see you.
So I understand. Let's first get through the earnings part of the equation here. You guys came out with your earnings the other day. In fact, let me see. Revenue up 29%, or up 17%, I should say. I believe.
That's right. Okay.
Yeah, right. EPS up 29. I'm probably confusing the numbers. Bottom line is, you reported a really good number, and yet the street was unhappy with something called your FFO guidance. It's a little complicated. Explain it in layman's terms to people. Why the stock's at an 8-year low based on that?
Well, FFO is really an acronym for cash flow, and reported cash flow for 2008. That was our 7th year in a row consecutive of 10% growth in cash flow per share. But the bad news is we have 3 development projects that are kind of holdovers from the early. These are long-term 2-year projects. And at their completion, they're showing signs of weakening financing, and so returns to equity are worse. And so we were guiding down cash flow per share due to the debt market that will occur in 2009 and probably back to the 2007 level, maybe roll back about 10%, and a dividend that might roll back as much as 10%. But that's still a $3 a share dividend, Alexis. And so, but people were disappointed with that because we've had such a good growth pattern, and we're not happy with it, but we're trying to accommodate the macroeconomy. We think as things get better, those results absolutely will improve, and we have a history, we think, of outperforming our guidance. So we hope we'll do better in 2009 than that, but right now that's what we see, and we're trying to be honest with everybody, but we still think it's a great value. It's almost now, the way it's priced, about a 20% cash yield for a cash dividend.
Yeah, I mean, when you look at it, I understand that there's the chance that you could cut that dividend by as much as 10%. Part of what you talked about in the earnings announcement is the fact of the matter is, look, you know, you invest in everything from malls and ski areas and vineyards, and the credit crunch is impacting them. I mean, I assume it's about higher credit costs. How do you continue to address that concern, or do you think that if we can get through this year, that 2010 will look a lot better?
Well, I think 2010 will look a lot better. I think we're going to get through it by slowing or stopping really all of our development, which is very challenged given the credit market right now. Some of the other retailers, you say, there is some stress. The good news is over 50% of our portfolio is the movie theaters, and that industry is doing great. Had a very good 2008, about flat year, but had some of the release calendar in the fourth quarter pulled off and moved into the summer of 2009. That'll strengthen the outlook for 2009. And so far, as you said, first ever $1 billion January. You had Martin Luther King weekend outperforming Thanksgiving, which has never been done. And the industry's up 20% so far in 2009 year to date.
It's actually incredible. It's exciting because I love movies, so I'm feeling really good about it. But, you know, it's interesting. The chief economist, Jack Kaiser, from the LA Economic Development, which a lot of people in that area in Hollywood pay attention to, he said that 2009 has gotten off to a very strong start. Maybe movie-going is recession-proof. Now, the statistics show, I think in 4 out of the 5 last recessions, it was in fact recession-proof. Tell me why.
Well, I think it's because it's the treat people can still afford even in tough times, and it is a way, when times are tough, to get away from those tough times. It's a way you can take off for several hours into another place and live and enjoy that and escape kind of the brutal of news of the day maybe, but and it's still very accessible. The price is still, albeit $7 to $10 or so, it is still a fraction, just a little bit of what might be live entertainment or an equivalent alternative for 2 or 3 hours of entertainment. So that's why people like to go out to the movies. It's something they can still afford, and it's a way to get away from what's going on.
You know, you're in Kansas City right now, and your properties are all over the country, but a lot of people talking about what's happening with Hollywood, how they're losing people. More and more producers are going where they're getting better tax credits in other places. What kind of implications does that have for you guys or for the industry?
Well, it's fairly neutral for us as long as the films are produced, but there are a lot of producers that are shopping tax incentives. There's no doubt about it. And a lot of states are putting out a lot of tax incentives and trying to lure those. It's still hard for a lot of films to move out of Southern California because of the trade support that's there, all the ancillary industries that support a production of a film. But they are moving out. They are taking some of those trades at times because the incentives are so great. And that is happening. But for us, we just need the film calendar produced so we have content for the theaters. And it still works out fine for us.
Let's hope it keeps going, because going to the movies is one of the best things we can do right now. David Breen, thanks so much. Great seeing you as always.